Dorothy did everything right. She worked for 33 years, she filed her taxes every single year, she never missed a deadline, and she is still overpaying the IRS by $3,400 every single year, not because she made a mistake, not because she used the wrong form, not because she did anything wrong at all. She's overpaying because there are legal deductions built into the tax code that she qualifies for, that her tax software never showed her, and that the IRS will never tell her about. And if you are over 65, there is a very real chance you are overpaying too, right now. And here's the part that should concern you. Most retirees don't even realize it's happening. They file correctly. They follow the rules. They pay what they think they owe. And every year, they quietly send thousands of dollars to the IRS that they were never required to pay. That is what this video is about. This is not about cheating. This is not about loopholes. This is not about anything risky. This is about legal deductions and strategies that exist specifically for retirees that most people never claim simply because nobody told them. And today, I'm going to show you 5 of the most common ways retirees overpay the IRS every single year. And I'm warning you now, even missing one of these can cost you thousands. My name is Kevin Retires. Every week I break down the tax rules, financial traps, and strategies that protect retirees from the things nobody else is explaining. If that's something you need, subscribe now and turn on notifications, because the next video could save you more than this one. Let me start with the one that costs retirees the most money, and almost nobody over 65 is claiming correctly. A married couple can overpay the IRS by $1,800 or more every single year and never realize it because their tax return looks correct. Their software says everything is fine, and technically, it is, but it's missing something critical. The first way retirees overpay is by not claiming every deduction they are entitled to as a senior. Most people think they understand the standard deduction, but what they don't realize is that once you turn 65, the deduction system changes completely. And in 2026, there are actually 3 separate layers of deductions that can apply to you. Miss even one, and you're paying more than you owe. Here's what most retirees see. If you're single, the standard deduction is $1,600. If you're married, it's $3,200. That's what shows up in most tax software. That's what people assume is correct, but that's only the first layer. Here's what most people miss. If you're 65 or older, you automatically qualify for an additional senior deduction. For single filers, that's another $2,050. For married couples, it's $1,650 per person. So already, your deduction is higher than what most people think. But it doesn't stop there. This is where things change, and almost nobody is talking about it. Starting in 2025, there is a new senior bonus deduction, an additional $6,000 per person. That means single retiree, extra $6,000 married couple, extra $12,000 on top of everything else. Now let's put real numbers on this, because this is where retirees lose money without realizing it. A married couple over 65 could have $32,200 base deduction, $3,300 senior add-on, $12,000 bonus deduction. That's $47,500 total deduction. Now here's the problem. If their tax software only applies the base $30,200, they are paying tax on over $15,000 of income that should have been completely tax-free. At a 12% tax rate, that's over $1,800 lost every single year. And this is happening to people who did nothing wrong. They didn't miss a form, they didn't break a rule, they just didn't know what to look for. Now let's go back to Dorothy. She's single, she's over 65. Her correct deduction should be $1,600 base, $2,050 senior add-on, $6,000 bonus. That's $24,150 total. If she only claims the base deduction, she is paying tax on $8,000 plus of income unnecessarily. Every year, that's where part of her $3,400 loss is coming from. And here's the key takeaway. The IRS will never correct this for you. If you miss it, you overpay. Now the next one is even more powerful, because it doesn't just reduce your taxes, it can eliminate them entirely on certain income, and almost nobody over 70 is using it correctly. A retiree can pay tax on $10,000, $20,000, even $30,000 of income they never needed to pay tax on, and it happens every single year. The second way retirees overpay the IRS is by not using the qualified charitable distribution, the QCD. Here's the mistake most retirees make. They take money out of their IRA, pay tax on it, and then donate to charity. They think they're doing the right thing, but financially, it's one of the worst ways to do it. Because most retirees take the standard deduction, which means their charitable donations don't reduce their taxes at all. So what happens? They withdraw $10,000 from their IRA, pay tax on it, and then donate that $10,000 and get zero tax benefit. Now here's the better way, and this is where things change completely. Instead of taking the money first, you send it directly from your IRA to the charity. This is called a qualified charitable distribution. And when you do that, that $10,000 is never counted as income. Not reduced, not deducted, completely excluded. That means no income tax, no increase in your AGI, no impact on your tax bracket. The tax on that $10,000 disappears. Now think about that over time. If you donate $10,000 per year, over 10 years, that's $100,000 that was never taxed. And it gets even better, because this doesn't just reduce taxes in one place, it affects 3 different systems at the same time. Lower income means less of your Social Security becomes taxable, lower Medicare premiums, IRMA, lower overall tax exposure. This is where most retirees miss the bigger picture. They think they're saving on taxes, but they're actually triggering more taxes in other areas without realizing it. And one more thing most people don't know. Starting in 2026, even people who itemize deductions lose part of their charitable deduction due to a new income-based floor, but the QCD completely bypasses that. So while other deductions get limited, this one becomes even more powerful. And yet, most retirees are still writing checks from their bank account, instead of using the one method that legally eliminates the tax entirely. That's not a small mistake. That's thousands of dollars every year. Now the next one is where things get even more dangerous, because this is where retirees lose money without ever seeing it on their tax return, and almost nobody is tracking it correctly. Most retirees never notice this next one until it's too late to fix it. And when it hits, it doesn't feel like a mistake. It feels like you were quietly overcharged for years. Here's what I mean. Imagine spending decades doing the right thing, saving, investing, being responsible, and then paying taxes you legally didn't owe, not because you made an error, because you didn't know one number existed. That number is called your combined income, and it controls something most retirees misunderstand: how much of your Social Security gets taxed. Now here's the part that surprises people. Social Security is not automatically tax-free. In fact, depending on your income, up to 85% of it can become taxable, and the trigger isn't obvious. It's not just your paycheck, it's not just your IRA withdrawals, it's a formula. Half your Social Security, plus your other income, plus even tax-free interest, all combined into one number. That's what the IRS uses. Now stay with me, because this is where people quietly lose money. Most retirees think once they cross the threshold, well, that's it, nothing I can do. That's wrong. And this is where smart retirees separate themselves, because every dollar you reduce from that combined income can lower how much of your Social Security is taxed. Not next year, right now. Let me make it real. Let's say someone is just barely over the threshold. They're unknowingly paying taxes on a bigger portion of their Social Security. Now, if they reduce their income by even a few $1,000s, they don't just save on that income, they also reduce how much of their Social Security becomes taxable. That's a double win, and most people miss it completely. Now, here's where it gets powerful. There are specific moves, legal, simple moves, that can lower that number. One of them we already touched, but most people still don't connect the dots. When you use strategies that reduce your adjusted income, you're not just saving in one place, you're triggering savings across multiple systems, and this is where retirees start to feel like the system is finally working for them, instead of against them. Now, before I show you the next one, quick question for you. How many of you assumed your Social Security was mostly tax-free? Just be honest, because this next part builds directly on that mistake, and it might be the one costing the most long-term. Let me shift gears for a second, because what I'm about to show you doesn't look like a tax problem at all. It looks like a normal investment decision, but it quietly creates a tax bill every single year, even when you didn't sell anything. This is where a lot of retirees get caught off guard, because they think, if I didn't sell, I don't owe anything. That would make sense, but that's not how it works. There are investments, especially mutual funds, that generate taxable income automatically, even if you never touch them, even if you never press sell. At the end of the year, you get a tax form showing gains, and now you owe taxes on money you didn't actually take out. And for many retirees, this becomes a recurring problem, year after year. Now here's where it gets frustrating, because it's not about how much you invested, it's about what you invested in. Some funds buy and sell constantly inside the fund. That activity creates gains, and those gains get passed to you, whether you like it or not. And the IRS already has that information. So when tax season comes, you're paying taxes on activity you didn't even initiate. Now compare that to a different approach. There are investments designed to minimize this. Less buying and selling, less forced distributions, less surprise tax bills, same market exposure, different tax outcome, and that difference compounds over time. Now here's the part most retirees don't realize. Even if your capital gains tax rate is 0%, those gains still increase your income, which means They can push more of your Social Security into the taxable zone, so even tax-free gains can create taxes somewhere else. This is where everything connects, and this is why random decisions start costing real money in retirement. Now think about this for a second. How many years has this possibly been happening without you noticing? That's why this next part matters even more, because this one doesn't show up as a surprise. It shows up quietly in every single pension check. If you've ever had a job where you contributed to a pension, there's something you need to check, because there's a very real chance you're paying taxes on money you already paid taxes on once, and that should never happen. But it does, all the time. Here's why. During your working years, many people contributed after-tax money into their pension. That means you already paid taxes on that portion. So when that money comes back to you in retirement, it's not supposed to be taxed again. It's just your money being returned. But here's the problem. Most retirees, and even some tax preparers, don't calculate that correctly. So what happens? They report the entire pension as taxable, every dollar, which means they're paying tax twice on the same money, once when they earned it, and again when they receive it. Now, the IRS actually provides a method to fix this, but they don't apply it for you. You have to know it exists, you have to calculate it, you have to claim it. Otherwise, the default is overpaying. Let me put that into perspective. Even a small monthly exclusion adds up over years. Hundreds per year, thousands over retirement, all because of one missing calculation. Now here's the bigger issue. Most people don't even know whether they had after-tax contributions, so they never ask. And if you don't ask, nothing changes. Now think about everything we've covered so far. This isn't about breaking rules. It's not about aggressive strategies. It's about understanding how the system actually works after you retire. Because here's the truth most people don't realize until later. When you were working, your employer handled a lot of this. Withholding, reporting, structure. Now, it's all on you. And the system doesn't slow down to explain it. It just keeps running. And whatever you don't adjust, you pay for. Sometimes for years. So let me ask you something simple. If the system is already set up to take the maximum by default, doesn't it make sense to understand where you're allowed to keep more? That's what separates retirees who feel constant pressure from those who feel in control. Same income, different outcome. Because one understands the rules and one is guessing. And the difference between those two is often thousands of dollars every year. Now here's what I want you to do next. Not next year, not eventually. This week. Look at your last tax return. Just look. Check your deductions. Check your income sources. Check how things were reported. You don't need to fix everything today. You just need to see it clearly, because once you see it, you can't unsee it. And that's when things start to change. If this opened your eyes even a little, don't keep it to yourself. There are millions of retirees right now doing everything right and still overpaying, not because they made mistakes, but because nobody showed them this. Share this with someone who needs it. And if you want to stay ahead of these changes, subscribe and stay with me, because this is exactly what we break down every week. Real rules, real money, no confusion, just clarity, and that's what retirement should feel like.